You have $1 million in a Roth IRA. If you don't, then today is the video for you. We're going to be talking about how to build $1 million Roth when you start investing in 2025 and exactly how you can do this and what kind of time frame it's going to look like. So as we start the new year 2025, you can start it off on the right foot. You can start investing, you can start saving, you can start putting money into Roth IRAs. Now, the reason why we talk about this when it comes to a Roth 401k, when it comes to a Roth IRA, Roth money is after tax contributions, which means if you have an extended runway, let's say 20, 30, 40 years to let this money grow, you can turn it into a multi-million-dollar portfolio with the contributions that you normally put in there because of the compounding aspect. Now, when you do get to that $1 million plus portfolio in a Roth IRA, it is after tax dollars. You do not owe any money on that money at all. You don't owe money on the growth. After you reach that 59 and a half, you can take money out of the IRA as long as you meet the 5-year rule, completely tax-free. Now, why is this my favorite form of retirement and the one that I put my most money into? It's because when you start thinking of retirement savings, if you're in a lower tax bracket or if you want to be in a lower tax bracket later on, after tax dollars make sense, and there's no way when you start thinking about trying to forecast exactly what tax brackets are going to look like when you get ready for retirement, it's going to be crazy. I feel like when we get to retirement, taxes probably are going to be a little bit higher. Things are going to be a little bit more expensive. And there are some caveats that we really need to go down there. So let's break this down. Now, first of all, creating a Roth IRA. Now, contribution plan, this is where you're going to do it. And if you're eligible for a Roth IRA, make sure you do not exceed the income limits. But when you look at contributions, 2025 contribution limit is holding steady at $7,000 if you're under 50. If you're over 50, you can actually do a $1,000 catch-up contribution. So you can put up to $8,000 into this. Now, contributing to the max starting out might be a little bit much if you're not really on board, if you're not putting money aside. Totally understandable if you're not maxing this out. But what can you set as a realistic target in 2025 for you? Might be 1,000, 2, 5, whatever it may be to start off in building out this Roth account. Now, of course, breaking it down is when you start thinking about contributions, what do you want to put in there? When you start breaking down that $7,000 limit, you're looking at $583 a month, $135 a week. You can break it down into smaller, lot more manageable chunks. And again, if you start thinking, I can't do $135 a week, what can you do? Is it $100? If it's $75, $50, even $25, will make a big difference when you're aiming for and trying to achieve that maximum contribution every single year. And it comes with automation. Now, when it comes to reoccurring transfers, guys, similar to a 401k plan, you have to do it, really set it and forget it. When you start thinking about consciously putting money in there, it is really a smart move. And I have seen this so many times. If you set it automatically, it's like the money isn't even there. When it's coming from either payroll deductions or it's coming from a transfer from like a checking to your Roth IRA, you can set it and forget it for that amount. Don't have to worry about it. Don't have to do anything. As long as you set your investment vehicle, which we'll talk about in a little bit, that's all you have to do. Now, of course, you can accomplish this by trimming some unnecessary expenses. When you look at your debit card statement, your credit card statement, canceling unused subscriptions, maybe cutting back on some things that are non-essential spending to up the amount that either you're doing in debt repayment, which that is the first phase, but also making these contributions. Now, remember, with the Roth IRA, because there are contribution limits, you have to be investing regardless of where you are for the debt structure. When we start thinking of 401k matches, that would be the first place that I'd look. After you're there, I would probably look to something like the Roth IRA to start investing in if you're not putting money into a 401k or if your employer does not match anything you're putting in there. Now, of course, you could make use of windfalls. Now, every single year, stocking away a bonus, doing some overtime, you have tax refunds, anything you could really put a boost into that IRA account without putting a strain on your budget. And of course, when you think of something like side hustles, anytime you can make some extra income, whether it's from a gig, whether it's from YouTube, like what we're doing here. And of course, if you like the content that I'm putting out on financial education, definitely consider commenting below and subscribing to the channel because we have new videos every single day. But whether you're working that side hustle like YouTube, you're selling products and services, you could funnel that money directly into an account, which personally for me, everything that we make on this channel through the memberships, through the super chats, donations, even YouTube AdSense, I put into an account. It is a YouTube AdSense account that I do have with M1 Finance. I have a link down below if you want to sign up for M1 Finance, but everything we do put into a YouTube AdSense, and I'm putting it into the HD, which of course is the Charles Schwab high dividend yield. And we are producing money on YouTube from a side hustle, putting it into a investment account that is generating income. So it is going to be a self-fulfilling prophecy and turning those investments and that money into more money through regular contributions. Now, of course, turning your contributions into investments. This is the part where I feel like traditional Roth IRAs, this is where people get stuck. When you start thinking big picture, your money in your IRA accounts has to be invested. We are not talking about sitting in CDs at, banks and credit unions. We are talking about investing in the market. And I'm going to show you exactly why. When we start thinking about CD contributions, right now they're running about 4%. So if you have your Roth money sitting in there, you are earning 4%, which means you are just keeping up with inflation. For a lot of times, if the money has been sitting there, most people are not even earning 4%. Most of the Roth accounts are earning about a 0.5%, which is absolutely nothing. Guys, you are losing money by keeping your money in those financial institutions if they're not paying you a good annualized return. So thinking about taking that money that is in the Roth IRA, putting it into something like an account with M1 Finance that does have Roth IRAs available, making your regular contributions in there, and putting it into an S&P 500 index fund, which if you've seen any of my videos, I love ETFs, I love index funds, but putting it in there, we have an average annualized return about 10%. So when you think about the 4% that financial institutions are offering, you're looking about 2.5x putting it into an account like an S&P 500 index fund and making it a big difference. So if you're investing that $7,000 annually, starting this year, and let's say today is day one, you open up that Roth IRA, you're starting to make your contributions. In 20 years, if it's growing 8%, you're at $345,000. Now, when you think about the average in the United States, you're already almost double the average income or double the average retirement fund than we see for a majority of Americans. If it's growing at 10%, you're at 441K. If we have a stellar year like we have over the last decade, you're at $564,000. You are already at $500,000 within 20 years. So think about this, guys. If you're 25, you're now 40, 20 years later with the growth, let's just say average of the S&P, 10%, you're at 441K. You are 45 years old at almost $500,000 in investment account. That's a pretty good retirement, and you still have a long runway for retirement. When we start extending this out to 30 years, again, thinking about that 10% growth, you're at 1.2 million. So again, think back to the scenario, you're 25 years old, you're saving your $7,000 annually with a growth rate of 10% over 30 years, you're just north of 1.2, almost to $1.3 million in this account. If the growth is a little bit higher, even 12%, you're at $1.9 million, which again is kind of crazy. And also when we start thinking about $7,000 invested annually for 40 years, so if you're 25, now you're 65, you have been investing $7,000 every single year for 40 years. Even at a 10% growth rate, you're at $3.4 million in that account. If we look at a 12% growth rate, you are north of $6 million just through IRA contributions. So think about this, guys. When we start thinking of the contributions we're making and the money we're putting in there, $583 a month over the course of 40 years just turned into $3.4 million. When you think about, again, the average in the United States being around 180K when it comes to actually investment portfolios, which is kind of crazy. So definitely today is the day. Get started on your $1 million Roth IRA. Kids are starting to invest a lot earlier. We're seeing the average age to start investing around 19, but what happens is people don't have a lot of money at that point to start investing. But even doing small investments, even doing, again, 25 bucks a paycheck, 50 bucks a paycheck with the compounding interest over a multitude of years is going to absolutely be crazy when you start thinking about what you can do with this. And of course, depending on where you are in life, let's say you're 25, you don't want to do those S&P 500 index funds. You want to go into something a little bit more aggressive. You could look at growth stocks. You could look at a lot of other assets out there that might yield a little bit higher than 10%. And of course, that's going to slingshot your portfolio into a much faster, much higher growth rate as it continues to snowball. So even though if your Roth doesn't hit seven figures, guys, you can definitely get there and build that $1 million retirement plan, making contributions into 401ks, taxable brokerage accounts, and of course the Roth IRAs, which I do recommend having a variety of them for the simple fact when you get to retirement, you really have to determine what is going to be the best method essentially to take funds out of. You know you're going to be having Social Security, so that is going to be income. You don't want to take that much money or have that much money, in my opinion, in traditional IRA accounts, because again, you're going to have to start taking money out with RMDs. RMDs are going to come with a big tax payment that you're going to have to put back. And of course, your portfolio will be exponentially bigger because you've had that growth factor in there. All right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think. And as always, thank you guys for watching.